Hello everyone, this is Ted Bauman here with your weekly Bauman Daily video on Friday. The markets are recovering a bit this week, although the volume and breadth of the recovery still, I think, calls into question how sustainable it is. I suggested last week that I didn't think this was basically we were going to be facing further declines. I know people like to jump in and question when anybody makes predictions. I stand by it. I still think we have further down to go between now and the end of the year. Whether you want to buy that dip or not, I don't believe that that's a good idea, except for certain sectors. And I'm going to talk today about one of them in particular. But before we do that, let's just look at some economic statistics. What's been going on in the markets recently. Here's a chart that shows the performance of the stock market month by month. Of course, this most recent month, September, was a down month. A lot of people have said, well, that's just an aberration. But as I argued last week, I believe that there are reasons to suspect that at the very least, we will not see consistent gains from here across the board, which is a good reason not to jump in. If you're jumping into the market at a high point, you want to be sure that there are going to be further gains across the market. And if those are not forthcoming, then what's the point of jumping in? You're just going to have to wait even longer for gains, which may never be forthcoming. Now, here is another chart that shows, I think, that the critical issue, which is the nature of this recovery. A lot of people have called it a K-shaped recovery, and I think that's a pretty good description. And that sets up, I think, some of the opportunities that we're looking for going forward. The critical thing is that the industries that have done well during the post-COVID recession, as short as it was, we know what they are. They're in the technical sector, technology. They're in big box retail and big retail like Walmart, Target. They're in software. They're in online retail, that sort of thing. On the other hand, everything else, travel, entertainment, hospitality, food services, is doing extremely poorly. So essentially, unless you're in big tech, big merchandise, biotech and pharmaceuticals, online entertainment like a Netflix, or a work from home type company or an online retailer, things have not gone well for you. Now here's a chart that shows basically what's happening to small businesses across the country, the number of them that remain closed. Most recently, I think this information was as of September 25th. As you can see, it's not good. I mean, here in Atlanta, where I live, 25% of small businesses are still not open. That includes some of my neighbors who are desperately struggling to get by. One of my friends owns a restaurant, a very good barbecue place that has just not been able to reopen. He's trying to make a living by selling food that is prepared in his kitchen, his restaurant kitchen, and then distributed. He and his co-owners are driving around delivering meals. So that's an example of how tough it is at the bottom. Now let's have a look at a chart that shows the job impact, basically the change in employment since the beginning of this year for different income levels. Now, anybody making over $32 an hour, you've actually seen an uptick in employment. It's up by 2%. Everybody else is down. But look at the very bottom, the people earning basically minimum wage or something around minimum wage. I mean, we're still looking at negative 16% unemployment, or rather, employment is 16% lower than it was at the beginning of the year. 20%. For those $14 to $20 an hour, it's still down 16%. And even for people in the middle, it's still down 5%. Now, what does that mean in practice? I think we know what it means. It means that certain categories of stocks have done well this year. Those of us who have bought them have done well, but other categories of stocks haven't. So here's a chart that shows how those are distributed. At the very top, you can see that technology, XLK, that's the Technology Select Sector SPDR ETF, up very strongly. And then after that, consumer discretionary expenditures, people buying all the stuff they need to kit out their home offices and everything else. But everything else below that, transports, energy, finances, utilities, all are in deep loss territory for the year. Energy, the biggest loser, of course. But fundamentally, all of those sectors are down. An interesting thing, I think, is that for a lot of those companies, their market capitalization is nowhere near as high as the big tech companies. So even though they're down, they don't contribute as much to the overall movement of big indexes like the S&P 500. So the S&P 500 appears to be doing better than the majority of the actual economy actually is. So basically, that's the backdrop here. Now, I know a lot of people think of me as a perma bear. No, I'm not a perma bear. I'm an economist and an historian, and essentially, things like this happen over and over and over again. Everybody thinks everything's going to be perfect. You have continuity bias. You think things are going to continue indefinitely as they have, let's say, for the last 6 months. Well, that's never the case. The tricky thing is to know when the turning point is. But I agree with a lot of people who say that it's impossible to predict. It's difficult to be accurate about it. I think that the critical thing, though, is to figure out which segments of an economy and of a stock market are likely to be moving in which directions at which times. And my basic thesis right now is that the top end of the stock market, the technologies, even the online retailers are unlikely to see the rate of gains in the future that we have seen in the past. That means if you start buying into them now, or if you add to your positions now, you're unlikely to see very big gains. However, there could be big gains elsewhere. And that's been my message. It's been our message on our Monday Your Money Matters videos, really for most of the last quarter or so. We're saying expect and anticipate and profit from a rotation into sectors that are at this point underpriced. And you position yourselves for much higher future gains if you do that than if you keep chasing particularly high stocks. And also if you chase story stocks as a day trader, but that's a different issue. So let's switch to the segment of the economy that I think is doing extremely well, especially under K-shaped circumstances. And it's doing, I think, extremely well precisely because of the K-shaped recovery. So like it or not, I don't like the fact that our economy is so unequal and getting more so by the day, but there's money to be made by catering to the people who are making money and pulling away from everybody else. And the sector to do that is in housing. Now let's look at a chart that shows the recovery of housing over the last while from my friends at Hoya Capital Real Estate. They do a great weekly publication on Seeking Alpha. Actually daily they put out an update on the REIT sector, real estate investment trust, and also housing and property. Now, as you can see, everything basically went to heck in the spring like everything else, but look at the rebound. I mean, just unbelievable. Existing home sales up just dramatically, catching back up to where they were in January. But look at new home sales, and this is the segment that we want. I mean, none of us are going to make money in the stock market from existing home sales unless you play support services like Redfin and maybe some of the companies that provide fittings for houses that people buy. But look at the pending home sales and new home sales, all just basically rising. Essentially, people are buying houses just at a rate of knots, and they're trying to get out of the cities. I mean, that's one of the big things that has been driving this, but it's not the only thing, right? It's not the only thing. It's not just the desire to get away from COVID. This next chart shows what it really is all about. That is the weekly average mortgage rates from Freddie Mac, the government parastatal. And as you can see right now, you can get a 15-year fixed rate mortgage for 2.36%. That is just crazy, right? A 30-year fixed rate, 2.88%. An adjustable rate mortgage is 2.9%. So right now, this is just the absolute best possible time to take on long-term debt in order to invest in some real property, and that is why people are doing it. So essentially, we have a combination of two things. We have a desire to change people's living habits. They want to get away from what is perceived to be the more dangerous, more densely populated inner cities, or basically more densely populated neighborhoods. Inner cities is a loaded term. And they want to move into suburbs, and not just because they want to get away from cities, they also want space to be able to work from home, because there's a perception that this is going to continue on for a long time. Now, as someone who has worked from home for most of his career, I can tell you that it is not something that is very easy to do, especially if you live in a condominium or apartment in an urban area and you have kids and that sort of thing. And That applies to a lot of those people who were at the top edge of that, or the top end of that employment graph that I showed earlier. The people who have actually seen an increase in employment since the beginning of the year. Those are the people who are driving this. They're the better off. They're the people who make good salaries. They're the people who are comfortable regardless of what's going on in the world. Now, what is that doing to the housing market? This next graph shows the degree of price change basically from July to July in two different periods. One is 2018 to 2019, and the other is this year, or rather 2019 to 2020. As you can see, prices for housing have been rising fairly rapidly across the U.S. Even in 2019, they were up by 5.2%, which is significantly above the price, or rather the inflation rate. This year, it's up 6.5%. So there is a lot of upward pressure on housing prices, and that's due, A, to increasing demand, more people wanting them, but B, it's due to lower interest rates, because all else being equal, the same house with a lower interest rate is going to attract a higher sell price, because at a given monthly payment, you can increase the sell price as the interest rate falls. So some parts of the country have just really done very well. The Mountain West, the East, South, Central, which is basically places like Texas, and the South Atlantic states, that would be places like Maryland. And of course, if you've noticed, I'm wearing a Maryland t-shirt today. I'll leave everyone to guess why. Anyway, basically, it has been a very good year for housing prices. So remember, that's not just something that benefits existing homeowners. It's something that also benefits housing builders. Now, let's look at a couple of ETFs that hold housing related stocks related to residential construction in particular. Because remember, when we talk about housing, we're not talking about signs on Sundays with balloons attached to them with people selling existing structures. We're talking about new housing stock, something that is desperately needed in the United States. Here's a chart that shows the relative performance of the two top housing ETFs, ITB and XHB, compared to the S&P 500 this year. As you can see, they fell much further and much faster than the S&P 500 during the March crisis. They tried to recover, but then they really picked up steam in May. That's when I made my recommendation to buy them. That's when my investment services at Banyan Hill Publishing began to buy into housing and housing related stocks, and we've just killed it. We've done extremely well. Now, as you can see, during September, these sectors also, these two ETFs also kind of had a bit of a pause, but look at the performance of ITB. ITB is beginning what you might call an ascending triangle, where you see that the lows are higher at each point, the highs are higher at each point. That suggests a big, maybe a jump in price coming up soon. XHB, maybe a little bit less positive in this, but basically trading within a bounded range. It looks like support levels are rising, the lows are lower each time, although the highs seem to be facing resistance. But look at the S&P 500, that's a downward facing channel. Now, this could be, next month could be different, but this is telling me that right now, compared to the overall stock market, housing is a good place to be. Now, one of the things that a lot of people forget when I talk about ETFs, and I talk about ETFs primarily because I really can't make specific stock recommendations. It's part of my job, so I don't want to give them away, but also because the Securities and Exchange Commission forbids people like me who write financial newsletters from making specific recommendations unless it's in the context of the newsletter. So just thought I'd point that out for those of you who wonder sometimes. But remember, every ETF is a collection of underlying holdings. So let's look at the top 10 holdings for those two ETFs. Now, XHB is the ETF that has done a little bit less well than the other one, ITB. So let's look at what its holdings are. Its top 10 holdings include Whirlpool, Carrier, both of which are essentially appliances, Fortune Brands Home and Security, that's Security System, Trex, that's Decking, DR Horton. That's when you get into the actual house builders, right? Trane down there, again, that's heating and cooling systems, Lowe's, Lennox. So basically their top holdings are in industrials, right, in relation to housing. And that sector has, or that ETF has not quite done as well as the next one, which is ITB. ITB it comprises primarily home builders, D.R. Horton, Lennar, Pulte Group, and then a bunch of support systems like Lowe's, Sherwin-Williams, Home Depot, TopBuild, Masco, and then Toll Brothers down there. So the lesson here, I think, folks, is that I think that housing is going to be a robust sector going into the next a year or so. I don't think that we face any significant headwinds. Interest rates are going to stay low. People at the top of the K are doing well for themselves, and they are going to continue to want to buy houses. So my recommendation is don't just look at the ETFs, dig into the companies that are holdings of the ETFs, make your own decisions. But I think you're likely to see better returns on those kinds of stocks over the next year than you will in the stocks that have really blasted the market this year. It's just a question of what future returns are likely to be like from here. That doesn't mean you sell your tech stocks. It just means that you need to possibly think about taking profits and rotating them into these other sectors. Anyway, that's it for me this week. Don't forget you can subscribe to the Bauman Letter down at the bottom by clicking on a link. If you ever have problems with your subscription, please email us. We are not here to cheat you. We don't cheat anybody. I know some people sometimes make comments saying that that we're trying to cheat you. That's not the case. It's just that technology, as well as it's doing in the stock market, doesn't always do perfectly in real life. Anyway, this is Ted Bauman signing off. I'll talk to you next week.